is authorized to declare recess of the committee at any time. This hearing is entitled Digital Assets and the Future of Finance, examining the benefits and risk of a United States central bank digital currency. I now recognize myself for 5 minutes to give an opening statement. While cryptocurrencies have the potential to offer several efficiencies in the way that we send and receive money, the early stages of innovation in this realm are revealing the clear risk associated with some cryptocurrencies, including significant volatility and even so called stablecoins that, despite their name, have been anything but a stable value. Earlier this month, we saw the dramatic collapse of Terra, which, according to one analysis firm, resulted in investors losing more than $40 billion dollars in a product that was supposed to always return $1 for each dollar invested. CBDCs have the potential to harness the efficiency of cryptocurrencies while providing the security and stability of the US dollar, backed by full faith and credit of the federal government. As we explore the possibility of a US CBDC and the future of the global financial system, we must keep in mind that we may very well be in the midst of a new digital asset space race, with countries around the world competing to deploy digital versions of their own currencies. And American can't be left behind. The United States dollar has long been the global leader and reserve currency worldwide, and Americans reap enormous benefits from having their currency widely accepted across the globe. For example, a reserve currency means that the United States government's cost of financing is lower, which translates long term into lower mortgage and credit card rates than consumers see in other countries. But it is not hard to imagine how another major economist, CBDC, could chip away at the dollar's leadership status because of efficiencies that CBDCs could offer in making instantaneous and secure payments at lower cost. According to estimates, over 90 nations representing 90% of the global GDP are researching, piloting, or developing CBDCs, including China, which rolled out its CBDC at the Winter Olympic Games in Beijing. As the U.S. explores the potential for our own CBDC, I believe the design of this digital dollar should balance the need for privacy protections while retaining mechanisms to prevent money laundering and other illicit uses. I also strongly believe that a U.S. CBDC should be designed to promote financial inclusion. These are values that I believe the Democrats and Republicans share, but values that other countries like China in this digital assets race space share. This is why it is critical for the U.S. to stay competitive in this field to ensure that our values prevail as the way that the global financial system evolves. First, let me extend my congratulations to Dr. Lael Brainard on her confirmation as the Vice Chair of the Board of Governors of the Federal Reserve System. I'm so happy you have joined us in this new capacity to discuss the potential of central bank digital currencies, or CBDCs, as part of the future of our financial and monetary system. Today, we continue the committee's bipartisan series of hearings on digital assets. This hearing will allow us to examine and discuss the Fed's ongoing research on CBDCs and to learn how the Fed is working with other federal agencies as encouraged by the White House in its recent executive order on digital assets to ensure that the U.S. is properly regulating the cryptocurrency industry. While cryptocurrencies have the potential to offer several efficiencies in the way that we send and receive money. The early stages of innovation in this realm are revealing the clear risk associated with some cryptocurrencies, including significant volatility and even so-called stablecoins that, despite, again, as I repeat, their name, have been anything but a stable value. Earlier this month, we saw again the dramatic collapse of Terra, which, according to one analysis firm, resulted in investors losing more than $40 billion in a product that was supposed to always return $1 for each dollar invested. And so I'm repeating all of this because I want it to be clear. And now I will recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Well, thank you, Madam Chair. And Vice Chair Brainard, thank you for being here today as we seek to understand what problems a Fed-issued digital currency would solve. Despite this being our third hearing focused on CBDCs and the Fed issuing its report, we still have many unanswered questions. But we knew that would happen. We all have to get a better understanding of the consequences of a central bank digital currency and understand the technical aspects as well. This is why, prior to the reports released from the Fed, my Republican colleagues and I developed a set of principles to guide our evaluation of a U.S. central bank digital currency, a U.S. central bank digital currency, or CBDC. For more than a year, we've been exploring the potential impact of a CBDC on monetary policy. We've been trying to understand the impact of the Fed's dual mandate and the implications for our banking system. Most importantly, we've been reviewing the Federal Reserve's current authority, if any, to issue a digital currency. Our principles provided a coherent framework to evaluate the Fed's report. In its report, the Fed listed a number of potential benefits of a CBDC, most of which, in my view, could be realized through private sector alternatives. There seems to be a disconnect about how innovation truly happens, which is outside the walls of government bureaucracies. We also don't know the impact of a digital currency on the Fed's ability to effectively perform its monetary and regulatory functions. And we're trying to explore that and understand it better. And no one has made a more compelling case on why we should expand. And let me restate that. And no one has made a compelling case on why we should expand the Fed's mandate into retail banking, or how a Fed-issued CBDC won't politicize the Fed. I understand that this issue is obviously in its exploratory phase. However, there is potential for significant harm to our financial system if we move forward without sorting through potential consequences. That's why last week, committee Republicans sent a letter to Chair Powell outlining exactly where the Federal Reserve should focus its next steps. Chair Powell has been outspoken in his view, stating, quote, "It's more important that we get it right," which means that we not only look at the potential benefits of a CBDC, but also the potential risks and recognize the important trade-offs that have to be thought through carefully. And I strongly agree with Chair Powell's assessment. Chair Powell in the discussion paper emphasized that, quote, the Federal Reserve does not intend to proceed with the issuance of a central bank digital currency without clear support from the executive branch and from Congress, ideally in the form of specific authorizing law. Since the job rests with Congress to make this decision, we should be thorough in our review. Congress should not rush to issue a digital currency, nor should the Fed. We both should understand whether the benefits of a digital currency actually outweigh the risks before any further congressional action is considered. Thank you, Madam Chair, and I yield back.
All right, who do we have next here? Oh, where am I? Thank you very much. I want to welcome today's distinguished witness, Dr. Lael Brainard, Vice Chair of the Board of Governors of the Federal Reserve System. Without objection, your written statement will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer that will indicate how much time you have left. I would ask you to be mindful of the timer and wrap up your testimony before your time has expired. Vice Chair Brainard, you are now recognized for 5 minutes to present your oral testimony.
Well, Chairwoman Waters, Ranking Member McHenry, other members of the committee, I'm very pleased to join you today. There has been explosive growth in a digital financial system built around new digital assets and facilitated by crypto asset platforms with stable coins as settlement assets. And in recent weeks, two widely used stable coins have come under considerable pressure. The recent turmoil makes clear that the actions we take now, whether on regulations or on explorations surrounding a digital dollar, should be robust to the future evolution of the financial system. That rapid ongoing evolution of the digital financial system should lead us to frame the question not as whether there is a need for a central bank issued digital dollar today, but rather whether there may be conditions in the future that may give rise to such a need. No decision has been made about whether a US CBDC will be a part of that future, but it is important to undertake the necessary work to inform any such decision and to be ready to move forward should the need arise. There are risks on both sides, risks of acting and risks of not acting. The share of US payments made by cash has already declined by 1/3 to 20% just over the last 5 years. And of course, the share is even lower for people who are under the age of 45. So as digitalization of the financial system continues, it's prudent to consider how to preserve ready public access to safe central bank money. And that's where questions around the issuance of a digital dollar akin to the Federal Reserve's issuance of physical currency arise. In addition to the migration away from cash, we're also seeing growth in new forms of digital private money, such as stablecoins. They don't share the same protections that underpin confidence in commercial bank money, such as deposit insurance, access to central bank liquidity, and banking regulation and supervision. They can lose their promised value relative to fiat currency, harming consumers and creating broader financial stability risks. And indeed, we saw in the 19th century active competition among issuers of private paper banknotes led to instability, inefficiency, and fraud that was so widespread that it led to the need for a uniform national currency and ultimately the protections I just noted. In addition to consumer protection and financial stability risks, if private money such as stablecoins were to become very widespread, we could see fragmentation of the US payment system into so-called walled gardens. In those kinds of circumstances, a central bank digital dollar could improve the stability and efficiency of the payment system by coexisting with and complementing stablecoins and commercial bank money, much like cash currently coexists with commercial bank money. It could provide a safe central bank liability as the neutral settlement layer in the digital financial ecosystem that would actually facilitate and enable private sector innovation. But it's very important to consider the risk of bank intermediation. A vibrant, healthy banking system with banks of all sizes is very important to the economy and to the Federal Reserve. And in some circumstances, a widely available CBDC could serve as a substitute for deposits. And a CBDC would be attractive to risk-averse users during times of stress. That's why we want to make sure that banks are among those intermediaries, if in fact we were to have such a system with intermediaries, which we have said is very important, and to develop design features to mitigate those risks. Finally, in addition to those two reasons, in future states where one or more major foreign currencies are issued in CBDC form, it's prudent to think about what the risks are in the presence or absence of a US central bank digital dollar. And of course, China's actions there are important, but other central banks in Europe and elsewhere are also pretty far along in terms of thinking about issuing their own digital currency. Of course, we shouldn't take the dollar's global status as the dominant payment currency for granted. So thank you very much. I look forward to engaging with you on this important issue.
Thank you very much. I now recognize myself for 5 minutes for questions. Vice Chair Brainard, one potential benefit that the Federal Reserve highlighted in its January CBDC report was that a CBDC could support the dominant international standing of the US dollar and can help to ensure that our currency is positioned to remain the world's reserve currency and primary medium of exchange internationally in this digital age. The report noted, and I will quote, "Today, the dollar is widely used across the globe because of the depth and liquidity of the US financial markets, the size and openness of the US economy, and the international trust in United States institutions and the rule of law. It is important, however, to consider the implications of a potential future state in which many foreign countries and currency unions may have introduced CBDCs." End of the quote. Some advocates have noted that if foreign CBDCs become more widely used than existing forms of the US dollar, the global power of our currency could decrease. As you look at the CBDC development in China and elsewhere, do you think that a US CBDC is essential to preserve the international role of the dollar?
Well, thank you, Chairwoman. So I think this is one of the important considerations informing the work to better understand the design and potential importance of a digital dollar. We do derive important benefits from being the dominant payments currency. It does lower our borrowing costs and our transaction costs, and that does flow through to businesses and consumers. So it's very important for us to retain a dominant position in international payments. And as you noted, China has already introduced a digital yuan. The ECB is pretty far along in its thinking. If a number of major foreign jurisdictions do in fact issue digital currencies, it's important to think how that would look for the dollar if the US did or did not join that. Regardless of whether the decision is made to move forward or not, it's very important for us to be involved in standard setting in cross-border transactions. And of course, our ability to shape those standards will be influenced by whether or not we actually have a digital offering to bring to the table as well.
Thank you very much. I just want to ask you about the president's direction. It seems that he said that all of these agencies should work together. And we talked with Mr. Su just yesterday, and he said there's been no real discussion on CBDCs. Is that true?
So the executive order on digital assets does, I believe, include a important role for Treasury in bringing together the banking agencies to discuss the issue of a central bank issued digital dollar. So I do think it'll be very important for Treasury to convene those discussions. And of course, we look forward to fulfilling our role under the executive order.
But it has not happened yet. Is that right?
It has not happened yet to the best of my knowledge, but we are working with other agencies on the executive order and do expect to have discussions convened by Treasury.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Vice Chair Brainard, you obviously are very steeped in the details of and the mechanics of a CBDC. We've seen the MIT report, we've seen the Boston Fed, and we've seen the overall Fed report on CBDCs. The one thing that the Fed report makes clear is that legislation is necessary for the Fed to issue a central bank digital currency. Is that your view?
Ranking Member McHenry, the report is clear that the Federal Reserve would not move ahead without support by the executive branch and by Congress. And ideally, that would take the form of authorizing legislation.
Yeah, I mentioned that in my opening statement, and that was my question. I was asking your view.
Of course, I don't have any expertise on the particular what kind of authorizing legislation would be necessary, but I think our view as an institution was clearly stated, and I
But
can repeat that.
you're the vice chair for regulation, and I just want to ensure that it's your understanding that the Fed is constrained by statute, and if it and that's why I'm asking. This is not supposed to be a hard question. It's supposed to be the easy opener.
Yes, so it is clear that the Federal Reserve does not have the authority, for instance, or is precluded from individual accounts. So we've taken a very strong position on that in the report. And yes, it is important for us to have strong support from both the executive branch and Congress. And ideally, that would come in the form of authorizing legislation.
Okay, well, I think you'll hear from me on this because it seems like there's some wiggle room you're trying to show. Let me move on to my set of questions, if I may. What specific problems, if any, will a central bank digital currency solve?
So I think this is a very important question, a set of considerations. And I think the way that I think about it is that it's really the future states of the financial system that we should be thinking about as we think about the costs and benefits. There are potentially risks to creating a CBDC, depending on the future evolution of the financial system. There are also potentially risks to not having a CBDC. And what is really important is it takes a long time. If, for instance, Congress were to decide that it's very important for the Federal Reserve to issue a central bank digital currency, it could take 5 years to put in place the requisite security features, the design features. And I cited earlier the enormous changes that have taken place in our financial system just over the past 5 years, a 1/3 decrease in the use of cash, a huge amount of migration to mobile apps for payments and out of the banking system, a introduction by several foreign central banks of their own digital currencies and plans by
Okay,
90%.
but
And
the
so it's
question I
really
have
important.
is,
Sorry,
I
please.
understand, and to this, my question is what problem we're trying to solve for. And I've not gotten a clear answer on this. For most consumers, payments are digital. The movement of cash between banks is digital. We see in the private sector the payment system working well. We see the Fed Now system is expected to go live in 2023. And so, what are the differences here from all those alternatives, and why the Fed would need to have a CBDC?
Yeah, so three reasons that I cited earlier, declining use of cash. So potentially consumers no longer having direct access to a safe central bank issued digital currency. That is one significant risk. Second significant risk is that stable coins become the dominant form of U.S. digital dollar. Sorry, I can hold. Should I continue?
And what's this?
And in that world, you could have fragmentation of the payment system, instability of those digital currencies, the kind of instability that Congress chose to move away from 100 years ago.
Thank you, Madam. Thank you.
Thank
Thank you,
you.
Vice Chair. And Madam Chair, thank you for this. I think this is the reason why we need to have a well-regulated stablecoin regime
you.
to at least start the conversation. Thanks
The
so much.
gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair. Vice Chair Brainard, thank you so much for being with us today. Appreciate it very much. As you well know, the Federal Reserve Board, the Federal Reserve Bank of Boston, has partnered with MIT to conduct CBDC related research through Project Hamilton. Together, they have studied the technological aspects of potential CBDC. I knew this was going to be hard because I say CDBG all the time and in my committee, but the CBDC, with the first phase of the project released in February 2022, which looked into cryptography, distributed systems, and blockchain technology. Some have argued that existing American digital initiatives for real payment times, such as FedNow, will likely have slower settlement times when compared to Project Hamilton or the CBDCs being developed by other nations. What is your view? Is there a Fed view? What is FedNow likely to do now? And will there will your study be laid out to us and to the Senate? We are, of course, very much interested in any sensible, well-studied work that will help us deal with this issue that is scary. At least to me, it's frightening to me. So, what will happen with the research?
Well, thank you. So the work that we are doing now on FedNow is on a real-time payments platform. It is the first system that we are building that is cloud native. And I think that we're learning a lot about the cyber security requirements, potential settlement times, the execution requirements. And so it's a very important build experience for us. And it's also, I think, is a good example of how long it takes from the time that the decision is made to build such a new platform to the time when it is ready to be connected up to financial institutions, to banks. There is relevance there for a central bank digital currency. And as you noted, we have a variety of research around the system that is potentially relevant, both to what it would take to execute on a digital dollar issued by the Federal Reserve, but also relevant to simply understanding some of the private sector platforms that have stable coins or are building stable coins. And so it is very helpful to us, for instance, through Project Hamilton, to experiment with what kind of throughput, what kind of settlement times, how many transactions per second you might be able to see when you layer on the kind of cryptography that's necessary to make these transactions secure and private. So I think the work that we're doing helps give us some background, and it's very important for us to continue with technological research and experimentation not only for purposes of our own payments infrastructure, but more broadly to understand the private sector and where some of the risks may lie and where some of the efficiencies may lie.
Do you believe that Fed now will likely have slower settlement time when compared to Project Hamilton or the CBDCs?
Yeah, so I'd be a little hesitant to compare simply because Project Hamilton is entirely experimental in nature. And of course, with FedNow, we're building in very significant operational resilience and security. And so, I'd be a little cautious about thinking about settlement times comparably between those two.
I'm sure you're back to balance my time.
Thank you very much. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Chair Waters. Dr. Brainard, if working people got paid in central bank digital currency, could it threaten the viability of commercial banks using deposits to fund their lending activities?
Yeah, so one of the things that I have focused most on in thinking about this debate is how important it is to our economy, to the Federal Reserve, to have a vibrant, resilient banking system with banks of all sizes. And we want to make sure anything we do continues to support that really important banking system. So as we think about some of those issues, I think one thing that is important is to recognize that anything that we would want to do in this space would have to be consistent with banks remaining really important intermediaries of any future evolution of the U.S. payments and financial system. And that's one of the reasons that we emphasize in our report that it should be an intermediated system with banks as intermediaries or among intermediaries. In terms of the deposits, there's certainly a lot of consideration that we've been doing in terms of thinking about potential implications for deposits. Banks are very important in terms of credit provision, in terms of monetary policy transmission. Of course, we're already seeing massive changes where payments are made increasingly through mobile payments apps. We've seen a tenfold increase of the leading mobile payments app, a sevenfold increase just in the last few years of the second mobile payments app. Those already hold balances largely outside the banking system. Similarly, we've seen those having some implications for cash usage. So I think any future evolution of the financial system with digitalization is going to lead to some diminished use of cash and some diminution of bank deposits, but that's also true for stable coins. You could see some reduction in bank intermediation and bank deposits there. So I think we want to think holistically about it, and it's very important to think about limits, potential limits on central bank digital currency holdings, whether to pay interest. That would be another way to make holdings of central bank digital currency really only for payments in ways that wouldn't compete with deposits if, for instance, they didn't pay interest. So there's a variety of ways people have been thinking about designing these so that they wouldn't diminish deposits in the banking system.
Thank you. Do you think that interest-bearing central bank digital currency could increase the threats to diminishing the role of the banking system in our economy as we currently know it?
So I think that question about whether or not a central bank digital currency would be interest bearing is a really important one. I think there are a variety of reasons to think it would be probably preferable not to have an interest-bearing digital currency. And the one that you mentioned, I think, is one of the most compelling reasons. It would be less attractive than deposits if it were not interest-bearing. And of course, consumers are accustomed to making payments on mobile apps without interest on those balances. So in that sense, it seems like a natural way to go to me, but it's one of the design questions that our paper raises and that we asked for feedback for in the comments.
Well, thank you very much. Madam Chair, I see my time is just about to expire, so I yield back. Thank you.
Thank you very much. The gentleman from California, Mr. Sherman, who is also the chair of the subcommittee on investor protection, entrepreneurship, and capital markets, is now recognized for 5 minutes.
Thank you. CBDCs will not meet the primary need that is aspired to be met by cryptocurrencies. Cryptocurrencies, the name tells you everything. Crypto means hidden, currency is money, and it is designed to meet the needs of those who need hidden money: drug dealers, sanctions evaders, human traffickers, and especially tax evaders. There's a second, and I don't think that central bank digital currency will help those folks, because you're going to enforce the know your customer and anti-money laundering rules. There's a second need that's met by cryptocurrencies, and those who may not care whether they hide their own money, but they want a hip, high-risk investment wager on whether other people will want hidden money and bid the price of cryptos up. Mr. McHenry asked, well, what could a CBDC do? And I'd point out that accounts of over $250,000 are not insured by the federal government. So if you want an account rather than like T-bills, you could buy it, then sell it, then use the money. But you want in the account money, and you want to take zero risk, and you have more than $250,000. CBDCs could do that, but there'll be a disadvantage that I think Mr. Posey identified in his question. Governor Brainard, given your role at the Fed, it's logical that you'd focus on digital currencies, but I also want to tap your knowledge about stable coins. We've seen that Terra was not terra firma, it was terra incognita. We see that Tether is completely untethered. I'm concerned particularly that Tether's investors are being told it's linked one-to-one with immediately redeemable cash reserves. We don't really have reliable financial statements to know that there are any reserves at all. But if we take at face value the releases out of Tether, they own commercial paper, cryptocurrencies, which could go up or down in any day, and a lot of investments in the notes of Chinese real estate companies, which are highly impaired. Earlier this month, the Treasury Secretary testified a need for Congress to take action and laid out a framework for doing so. Congress is somewhat divided, as you may have heard. We may not be able to pass anything. Is there anything you can do, or that the regulatory agencies can do, to protect those who think they're buying something stable and in fact are buying anything but?
Yeah, so I've certainly been very focused on the potential unstable nature of so-called stable coins for some time. And I do think the first best answer would be for Congress to legislate specifically a regulatory regime for stable coins. I do believe we've just seen in the last few weeks exactly the kinds of risks that we've all been talking about for some time. A run on the platform, a collapse in the value of a stable coin breaking the buck or moving off its one-for-one value because of lack of transparency into the reserve assets supposedly underlying the stable coin. All of those things we've all been talking about, and that's why I think the President's Working Group principles for regulating are good, and it would be first best to see some legislation there. There are consumer protection risks, there are investor protection risks, there are financial
Governor, I'm
stability risks.
going to sneak in one more question. I think Mr. Posey brought this up. We tend to focus on the financial services system, but the real impact is what an impact financial services then has on the real economy. We want business loans made, we want home loans made. If we had a CBDC, would that cause deposits to move out of banks, particularly community banks and credit unions, and into the Fed in a way that would provide less money available for the loans we want banks to make?
Yeah, so I think with the right design features, that could be avoided. Again, we already have payments apps that would operate quite similar to central bank digital currencies. The financial system is already moving in that direction. And by simply doing things like not having interest on a digital currency, potentially limits on how much people could hold, it would confine their use to payments and not impede those important functions of a vibrant banking system. And of course, again, it's really important for banks to be intermediaries in any such future system.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair. Good morning, Governor Brainard. Just want to kind of get a little bit of a clarity here. You keep saying that the Fed will move forward, would not move forward without congressional approval, ideally in the form of legislation. That's kind of a hedge there that I'm concerned about. So do you or do you not believe that we have to have legislation? And if you don't believe we have to have legislation, what other forms of a nod toward approval would you accept? Some sort of a letter from the administration, from Congress, a floor speech, the lack of action, for instance. Would that imply that everything was okay? Can you give me a little more definitive answer on this, please?
Yeah, let me just repeat what we have said. The Federal Reserve discussion paper that was released in January said that the Federal Reserve would not move forward without strong support from the executive branch and Congress, ideally in the form of authorizing legislation. And of course, I think that would
That's the
be.
word I want clarified, Madam Governor, is ideally here. Is it the only form that you go forward with, or is there other ways that you would consider approval from Congress and administration? I want to nail this down. What do you think it takes to make this happen?
Yeah, so I believe in the executive order on digital assets. The Department of Justice has the responsibility for opining on this topic. Others who are lawyers probably are better placed to give you a very precise answer. I can tell you that we believe that Congress should be very engaged on this issue. That's why I'm so delighted that you're holding this hearing today. There are a lot of really important questions that I think you're asking here. And our job is to make sure, at least the part of this that I think I have some responsibility for, is to make sure any decision that you take is well informed. That's why we put out the discussion paper. That's why we think it's important to have technology research. I would hate for Congress to decide 5 years from now, you Federal Reserve, you need to catch up. China's out there, the ECB is out there, and we would be serving you very poorly if we hadn't done a lot of work.
Okay, thank you. Along that same line, you've opened up another question for me here with regards to other countries, China, Europe, UAE, that are acting in this space, and the Fed is thinking about doing something with, I guess, consent and approval or direction from the Congress and from the executive branch. My question is, do you think that you can move fast enough to be able to compete with these other currencies And if not, do you think that the private sector, which I think we all agree can innovate and do this much more quickly, that if you worked in concert with them or turn them loose, that the innovation that they could come up with may be able to make us more competitive more quickly?
Yeah, so in any circumstance, we operate alongside the private sector. That is true of all of our payment systems that we operate today. It's true of the coexistence of cash and central bank money. And that's one of the great strengths of our system. So in any circumstance, I would think of potential digital dollar as creating a neutral settlement layer that would actually allow our private sector to innovate more effectively and more rapidly. If I think about where other countries are, by doing the kind of technology research and policy research and soliciting input today, I'm hoping that we, working with the private sector,
Okay,
can be in a good position.
can you give me an instance of how you're working with them? How are you working with the private sector?
Yeah, so in all of the work that we do, we have private sector partners. So in FedNow, for instance, we have a group of private sector partners that have helped inform the design of our system. And of course, all of our payment infrastructure is kind of is a neutral infrastructure that allows interoperability between private sector solutions. And that's how I would continue to see the role of the Federal Reserve in the future.
Okay, thank you. I see my time is up. I yield back,
Thank
Madam Chair.
you. The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you very much, Dr. Brainard, for your presence here. As the chairman of the subcommittee that has jurisdiction over the possibility of a CBDC, I'm really excited that we're having this conversation and deeply appreciative of the work that you've done. And I'm appreciative of the minorities' engagement here. I studied their letter of May 18th, and I want to make some observations and maybe get your view on some of this. For just for the record, the minority is very focused on the statutory authority. I think it would be very wise, whatever the legal niceties are, for the Fed to move forward with statutory authorization, because this is a big deal. But I want to make an observation. The minority accused you of failing to identify the payment system inefficiencies. I think I'm quoting them right in their letter. They write about identifying the problems in the current payment system. That's not a hard question to answer, Dr. Brainard, right? I mean, there are still millions of Americans who don't feel comfortable using commercially backed payment systems. They tend to be immigrants. They tend to be lower income people. That's correct, isn't it?
Yes.
Yeah, and I suspect that that's always going to be true. And look, I think it's important for them to have the option to do it, but there is something unique about the full faith and credit of the United States government, and that's why, of course, people use physical currency. I also want to spend a moment. I was a technology banker back in the 90s, and I watched the internet develop. And the truth is that in the mid 90s, we had no idea what the internet was going to be. We had no idea in the late 90s that someday the internet would enable your refrigerator to text you at your office to tell you that you needed more milk. We didn't dream of that. I'm not sure that we would have looked at travel agents and said that's a clear, inefficient system at the time. And so my point is that we just don't know, but we would be making a terrible mistake if we stood in the way of innovation, because the problems of today don't actually indicate where this may go. The second issue I want to maybe get your agreement on too, and I worry about the minority sort of, because I think the outcome here is one in which the federal government and the Federal Reserve provides a foundation upon which the private sector innovates in a big way. It should not be, the government should not squeeze out the private sector, but I wave this thing around a lot. This is the iPhone that I use. We're all enslaved to these things, but this is the metaphor for what we're doing. because this thing is made by a private company. It's got apps and semiconductors and all sorts of things that have created immense wealth in the private sector. But this thing is cool because decades ago, the federal government invested a huge amount of money in semiconductor research. It's pretty cool because the federal government created the ARPANET in the Advanced Research Project Agencies, which led to the internet. The only reason location services work on this device is because the United States government maintains 31 global positioning satellites above our heads. And the reason I tell that story is because this is the story of innovation. You can call it a partnership, you can call it a foundation that the government sets that the private sector builds on. But it's really important that we remember that that's the nature of innovation. Because look, I'm a general cryptocurrency skeptic here, but I don't ever want to do something including demanding use cases that are very, very specific at a time when we could find ourselves as a competitive disadvantage. So, Dr. Brainard, I worry about this. If we wake up 6 months from now and the EU has created a digital CBDC equivalent of the euro, or if the British have developed a CBDC sterling and their private sector in Europe is innovating on top of that foundation, could we find ourselves at a real innovative disadvantage?
Yes.
And you talked about this before, but if that happens and the apps that get built on a euro or a sterling CBDC are really attractive, is it possible that around the world people would migrate away from the dollar as not just a reserve currency, but as a use currency?
I think it is, yes.
So there's a very real risk to our traditional position as an innovator if by having some ideological split that doesn't exist between the government and the private sector, we allow, I don't worry so much about China, who's going to trust a Chinese digital currency, but Europe or the UK or someone else to move ahead of us. So there's some really important risks, and you've highlighted them associated with CBC. We do not want to disintermediate the banking system. We don't want to create a flight to quality in panicked moments. But is it possible that an intermediated system like you called for, with wallets that perhaps are held in the private sector, but which are capped in the amount that one can hold, and that perhaps are not interest bearing, can you sort of conceive of a structure like that, which really creates no risk for the existing financial services system?
Certainly, in the research that we've done and the paper we put out, it is those caps, the lack of interest that would help to protect the banking system from any disintermediation of deposits.
Thank you.
Thank you, Dr. Brainard. My time has
The
expired.
gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Madam Chair. And Governor Brainard, thank you so much for your insights into this important topic. Wanted to follow up on Ranking Member McHenry's and Congressman Luchtemeyer's questions about the need for congressional authorization. You reiterated that your January report states that the Fed would not issue a CBDC without congressional authorization. In that paper, the Fed committed to moving forward with the CBDC only with clear congressional support, quote, ideally in the form of a specific authorizing law, unquote. You've reiterated that today. But I want to get into this executive order that you mentioned in response to Congressman Luchtemeier. That March 9th executive order requires the Attorney General, in consultation with the Secretary of Treasury and the Chairman of the Fed, to provide an assessment of whether legislative changes would in fact be necessary to issue a central bank digital currency should it be deemed appropriate and in, quote, the national interest. This, to me, suggests that the administration is not yet convinced that Congress has a role here. Tell us how the Fed is coordinating with Treasury on this. And if Treasury and the Attorney General take the position that congressional authorization is not necessary, will you, Chairman Powell, and your General Counsel, Mr. Vander Weide, commit to pushing back to protect the important role of Congress?
Well, I appreciate the question. I can certainly say that you're right that that is what the executive order asks for. No, I have not been engaged in any of those conversations, but of course that's not my expertise, so it would not be likely. But I believe that there have been some staff level discussions between the Federal Reserve, the Department of Justice, and Treasury. And of course, I don't know where those discussions are going to go. So the kind of hypothetical circumstance that you mentioned, it's very hard for me to speculate on that.
Well, what I think Congress is expecting, and I hear some bipartisan support for this from Mr. Himes, is that your general counsel and Chairman Powell, as the executive order requires to coordinate with the Attorney General, take the position you're taking here today, that congressional authorization is required, and we will be following up with you on that. Let me follow on this deposit substitution concern about a CBDC. You mentioned that a key objective of a CBDC is to promote financial inclusion. You're hearing today concern that this actually might compromise access to credit. A CBDC would compromise access to credit, especially in rural community bank dependent areas like my district. That moving deposits off bank balance sheets may be harmful to the very people we're trying to help. Um, Talk about that a little bit more, and as you do, um, I'll just quote the Fed itself, quote, a widely available CBDC could serve as a close substitute for commercial bank deposits or other low-risk assets such as government money market funds and treasury bills. A shift away from these assets could reduce credit availability or raise credit costs for households, businesses, and governments.
Yeah, so let me just start by saying that I'm very focused on the role, particularly of community banks in rural communities, and the really important and unique role they play in providing credit, in particular to small businesses and to communities there. So it's a very important uh, link to financial inclusion for rural communities, and I certainly care a lot to make sure that our community banks are vibrant.
Can I reclaim real quick and get to your point about intermediation and caps, because I know that's your solution, but I worry that a CBDC, even an intermediated CBDC where the accounts were capped at 5,000 per end user, would still result in $720 billion in deposits leaving the banking system, and that would in fact impact community banks the worst, because they have 46% of community bank deposit accounts have less than a $5,000 balance.
So I think what you can already see today is that there is a big migration of consumers, particularly young consumers, to mobile apps for payments, particularly for P2P payments. So we've just seen a tenfold increase just over the last few years alone. Those balances are already not being held in community banks. If you saw stable coins being prominent in payments, that would also lead to migration. So I think we need to think broadly about the future of community banks and the vibrancy of deposit holdings in a world that is rapidly digitizing on payments. And of course, as you noted, any system, any design considerations would include a prominent role for banks of all types as intermediaries. And we certainly are thinking a lot about, are there kinds of restrictions like no interest payments, restricted caps that would help guard against risks in moments of instability.
How does the
Excuse me,
intermediate?
the gentleman's time has expired.
Okay. So many
The
questions. Thank you.
gentleman from Illinois, Mr. Foster, who is also the chair of the task force on artificial intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. There's been some discussion here about, what problem might this be solving? And so if everyone had access to, either a Fed account or Fed-backed stablecoins, which were widely used for consumer and commercial payments at negligible cost, roughly how much would vendors and consumers save in credit card fees?
I don't have a specific estimate for you, but certainly transactions costs are very high currently, as we know
Yeah.
from.
If you
from
could get back with an
McHenry.
estimate, I'd appreciate it, because that's a big potential consumer benefit. Now, it seems to me the first safest step here would be stable coins issued by a regulated financial institution that were 100% backed by Fed reserves. Okay, that seems like the safest thing you can imagine. And the main thing that would be required for this to happen was that the Fed would provide an API to verify in real time the reserve account balances, so that anytime anyone was going to mint a stable coin, the minting process could not complete until the Fed had verified that the updated account balance was in fact on reserve. It seems like technically this should be a fairly straightforward thing, and I wouldn't be surprised if the parts were already in place in the regulated financial system to make that happen. This approach would also neutralize any monetary effects of changing stablecoin balances. So it seems from that point of view, it would be a pretty safe things. And so what would the residual dangers in an initial approach like this? And is this really a project that would take 5 years?
So, of course, private stablecoins could and are growing in usage every day. And so what would be different? First, as you say, a entirely reserve-backed stablecoin with very strong regulations and guardrails around it would mitigate some of those financial stability risks. It would not mitigate risks of fragmentation of the payment system or of walled gardens. And so that's another really important aspect, I think, of thinking about whether you want a neutral settlement layer that might underpin a variety of stable coins and other private innovative solutions. And fragmentation of the payment system is costly, as we know from previous periods, when it makes it difficult to move from platform to platform. It introduces large inefficiencies. Similarly, if you think about the cross-border case, and in particular the cross-border wholesale case, where I think banks are particularly focused as potentially lowering transactions costs, there too, you'd either have a large number of stable coins, in which case you might have some fragmentation and inefficiencies, or you'd end up potentially with one very concentrated stable coin, which would require even more regulatory oversight. And of course,
So
any
when
such
you mentioned,
stablecoin
when
would lead to the
excuse me.
same kind of disintermediation risk as a central bank digital currency.
Okay. Now, in your testimony, you highlighted the fact that the discussion paper indicated that a Fed-issued CBDC would best serve the needs of the United States by being privacy protected, intermediated, widely transferable, and identity verified. You mentioned that you'd also need legislation to proceed with CBDCs. Do you also feel that you'd need legislation on the digital identity front to make this a realistic possibility? Is that a necessary part of any CBDC program?
So
Or do you think, yeah, are the standards in place already sufficient for that?
I'd say two things there. One, we talk about trying to strike that balance between privacy and identity verification by leaning on the current system that we have with banks as intermediaries, where banks are responsible for identifying, for verifying identities, and consumers as a result have privacy. There's no direct visibility into consumer transactions on the part of the government. But you're asking a broader question about digital identities, and that's really outside the purview of what the Federal Reserve is knowledgeable about or responsible for. And I think it's a much broader and it's a very important question.
Well, all right. Yeah, so if you could just
The
let us know
gentleman
who's
from
actually carrying the
Arkansas,
ball, I'd
thank you.
appreciate it. Okay, thank you. Yield
The
back.
gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Well, thank you, Chair Waters, and again, we add my congratulations, Dr. Brainard, as you are now our new Vice Chairman for Regulation at the Fed. This committee's work on digital assets has been one of the bright spots in recent years, and I thank our members for their hard work. I think our committee is among the best informed members of Congress on the subject of digital assets, and that's due to the strong bipartisan engagement on that over the past few years. And I appreciate particularly the work of the ranking member and of the chair on the committee and for working on a bipartisan basis here. I've been urging full consideration of a central bank digital currency or CBDC for about 3 years now. And last year I introduced with my friend from Connecticut, Mr. Himes, the 21st Century Dollar Act to make sure that the US government has a strategy to maintain the dollar as the primary global reserve currency now and well into the future, with or without a central bank digital currency. And in 2019, Congressman Foster and I authored H.R. 2211, Central Bank Digital Currency Study Act, which directed the Fed's Board of Governors to study a potential CBDC, its impact on consumers, businesses, monetary policy, and the U.S. financial system. And while that bill hasn't passed, we're here today talking about precisely that kind of a study. So I'm delighted to see the work by the Fed, both with the private sector and MIT, to conduct this study. And I was also pleased, I think I heard Dr. Brainard confirm that they would not issue a central bank digital currency without clear legislation from Congress. So I thank Mr. Himes and Mr. Foster for working with me on these issues. In thinking back, looking at the Fed's report, one quote stood out at me. The Federal Reserve Act does not authorize direct Federal Reserve accounts for individuals, and such accounts would represent a significant expansion of the Federal Reserve's role in the financial system and the economy. So, Dr. Brainard, just confirming with you, you stand by that and you don't support direct consumer accounts at the Fed. Is that correct?
Yeah, I think our statute is clear on that.
Yeah, thank you. And it seems like a clear indication to me also, if the Fed understands that if a CBDC were to be created here in America, it should be intermediated through the private sector, whereas companies, not the government, would offer these accounts and digital wallets to facilitate the management of CBDC holdings and payments and innovations. That would be also reserved for the private sector. Is that also, again, your confirmation today?
Yes.
Yeah, so we've been talking a lot about, consumer benefits about payments being reduced in fees, for example, in offshore dollar exchanges like MoneyGram and things like that. A big part of our hearing a few years ago with Libra and Facebook at that time. But I wouldn't call current digital asset transfers on blockchains cheap. Would you say they're inexpensive now to do that?
The numbers I've seen are actually quite expensive. Yeah.
Yeah, and also settlement times are long, are they not, compared to if I use my debit card at the Longworth cafeteria and debit my account through Visa debit, blockchain settlement times are also not instantaneous. Is that not correct?
That is correct.
Yeah. So there are, operational issues that we have, as you say, a lot of work to do before we just instantaneously think this is going to be successful. Are you testifying in a general way that you really prefer a CBDC over a stable coin innovation regime? Is that unfair for you to say that that's your view? Or is that a fair way to describe it? That you prefer actually, a U.S. government issued CBDC through an intermediary overseen by the government versus a number of stable coins?
No, I really see the potential for a digital dollar as being complementary to a more stable, efficient system that would include stable coins and commercial bank money. So I really see them as potentially enabling private sector innovation and as wholly complementary. And of course, just to your earlier question on blockchain, obviously blockchain has some real inefficiencies associated with the proof of work, the way that it verifies any kind of ledger with a central permissioned authority like a central bank wouldn't have those kinds of inefficiencies on settlement.
Well, thank you, Dr. Brainard and Madam Chair. I've got some additional questions I'll submit for the record, and I'll yield back.
The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you, Chair Lady. Dr. Brainard, I'm worried. You know, I'm also, as the Chair Lady said, chairman of our House Agriculture Committee, in addition to being a senior member on financial services, 20 years. And it's put me in the pivot of the two essential things that we cannot survive without: food and money, access to food, access to money. And so let me share with you why I'm worried. Because we have unbanked, underbanked. We have those people who don't have access even to the infrastructure of our financial system. I'm also working and concerned about the failure of us having financial education to educate people. We're making drastic moves with this cryptocurrency and the subject we're addressing today. So let me ask you, so you can address my concerns. How would a Fed-backed digital currency address the various reasons that our low-income consumers say why they're being unbanked? They say specifically they have lack of physical branches in the facilities. What role would that be? They say they have minimum balance requirements. And then also this general distrust of our financial system. How do you address that? You made a statement in your report. You said that a central bank digital currency could have helped millions of unbanked and underbanked Americans during the pandemic. You suggested that if the federal government had the option of providing digital cash, people without a bank account could have received payments, relief payments, faster and more efficiently. How do you say that? How can you back that up, ma'am?
So I think the reasons that you noted are the reasons that we see in our surveys and FDIC surveys why more than 5% of our population doesn't have a bank account, and that does include cost-related concerns. First and foremost, such as minimum balance requirements and unpredictable or high fees, as well as lack of trust, and as you also noted, lack of convenience, lack of branches potentially. Now, of course, there are some products out there like the Bank On initiative that banks are offering low cost, low risk consumer checking accounts. I certainly hope that will improve financial inclusion. But many consumers are also moving to payments methods outside the banking system because they're accessible, they're on apps, and because they don't have those kinds of minimum balance requirements. So it's possible that a digital dollar issued by the central bank could be part of an ecosystem that lowers transactions costs.
I only have a moment here.
Sorry, yes.
With all that you said, answer this for me. How do we overcome the challenge of having unbanked and underbanked communities view a central bank digital currency exactly the same as if they had a bank account? I mean,
Yep. So a central bank digital currency is really more like a cash analog. It's really in the digital world, the equivalent of holding on to cash or currency. It's direct central bank issued safe money. Consumers hold that right now in the form of currency, but currency is not always accepted any longer. It's hard to buy.
I have 7 seconds, 6 seconds, but please. make a point to address these. We got to bring everybody along with us, including the unbanked and underbanked. And until we have that done, we cannot move ahead and be functionable for all Americans.
Thank you. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and Ranking Member McHenry, Vice Chairwoman Brainard. Thank you and congratulations for your testimony. And I'm glad we're doing this hearing. I wish we had scheduled it when we were in town. I think the live in person adds a lot of value, but I'm glad we're doing it nevertheless. And Ms. Brainard, earlier when my colleague, Mr. Barr from Kentucky, was talking with you about your inquiry from the executive branch, you pointed out that you hadn't personally been contacted, but you also said, well, you wouldn't be the subject matter expert. If that's the case, why are you our witness? I think I want clarity there. You seem to be handling the questions well. So who is the subject matter expert that the administration would be working with, if not you?
Well, I think it's our general counsel's office would be the group of people that interpret our statutory language.
Okay, so you mean on statute, not necessarily on the subject at hand, central bank digital currencies.
No, my apologies. I was really referring to that specific question about statutory language.
Okay, wonderful. Well, thank you for that, and I appreciate the chance to clarify it. And when you talk about the just recently with my colleague, you pointed out that the analog is more to cash, and so if a person holds $100 of cash in their wallet, is it okay? Is that something the Fed would consider a vulnerability to public safety that must be reported or monitored?
No, there's a really important difference, I think, in terms of the anonymity of cash, the potential anonymity of cash. And of course, in any future state, cash would continue to be an option for consumers. The real
Yeah. So
question
is it a vulnerability if a person holds $1,000, or what about $10,000? Is there a point where holding cash is some sort of vulnerability to the financial system?
um, the financial system and consumer preferences are moving away from cash. So this is really just an observation about what's actually happening. We're very committed to provision of currency. We've got a lot of really important responsibilities in that regard, and we'll
Yeah.
continue to be very committed to
I
currency.
asked the question that way because, frankly, while cash isn't really illegal yet, there is an effort to make the digital equivalent of cash illegal. This is a rulemaking, frankly, first attempted under Secretary Mnuchin and now contemplated under Secretary Yellen, that would ban self-custody. And self-custody of digital currency is essentially the same as self-custody of physical currency or cash. So why do you believe there's a scrutiny there?
Yeah, so that is really sounds like something that Treasury would be best placed to address.
Yeah. As you contemplate central bank digital currencies, what would you consider a permissionless peer-to-peer transaction? Because that's the nature of cash. So if we're trying to preserve that, wouldn't that make any future central bank digital currency essential that it also preserve those characteristics?
So that is one of the kind of most, I think, profound questions that we raise in our discussion paper. There is that tension between potential anonymity and concerns, as were noted by other members of the committee earlier, about potential illicit activity and anti-money laundering.
Yeah, that's why the government's almost banned cash, not entirely. And to Mr. Scott's concern, the unbanked and underbanked community, they're already distrustful of banks, and they tend to not have accounts. They want to stay in cash, and sometimes for good reason, not illicit activity. And I note, frankly, in an adjacent point, 40 of my Democratic colleagues sent a letter to Google because they were concerned that the geolocation tracking could be used by people to regulate abortion. And the reality is their concern on abortion might seem more partisan, but the concern is the surveillance state. And while geolocation can do that, nothing. There's a reason they say just follow the money for a reason. So we've made cash almost impossible to use, and I think that hurts the unbanked and underbanked most. Lastly, I'll say if you turn the central bank digital currency into this creepy surveillance tool and don't preserve the permissionless characteristics of it, it's going to hurt. It literally is what China is developing, and we shouldn't imitate them. We should protect America's way of life.
Thank you very much. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you very much, Chairwoman Waters, and I'd also like to thank Vice Chair Dr. Brainard for appearing before our committee today. Much has been touched on, but it gives me a great opportunity to segue from Mr. Hines, Mr. Davison, and Mr. Scott. You know, when I think of technology, going back to Mr. Hines, in my district, because of the Intel project, hopefully that will be here, we're going to have a small microchip that's going to control just about everything that we're doing. And I put this in the same alignment when we start talking about whether it's Sandbox, whether it's Coinbase, and any other form of the cryptocurrency, is education and awareness. We know what happened with the stimulus checks. You know, we had a great idea, we got the monies out there, but because of the lack of education, the lack of banking for those who had bank accounts with businesses, but to be in good standing meant you had to have had that much money. So my question, Madam Vice President Chair, is how do we get the under and unbanked educated on this? I'm hearing people well educated on the Financial Services Committee. I'm skeptic. You know, many would say this is the wild, wild west. I believe it's the new frontier. I am not as skeptic. I just returned from a CODAL in the Caribbean with Congresswoman Waters and got probably the best education on cryptocurrency there with many experts in the Bahamas. So, what is our education and awareness plan? That would be part two, and for everyone, but especially for the under and unbanked. And then I'll just give you my next question and you can roll the response in. And you've touched on it and it's been asked in different ways. But when we look at 85% of central banks, that is a good portion that currently are exploring digital currency and end up issuing them. And theoretically, let's just say the United States does not. How does that affect us in our international landscape?
Let me just quickly respond to the second question first. I think it's very important for your committee and for Congress generally to be asking that question. I don't think we can take the global status of the dollar for granted. And in a world where other major jurisdictions move to the issuance of their own digital currencies, it is important to think about whether the United States would continue to have the same kind of dominance without also issuing. It's possible, but it's a very important question.
Let me ask you one other thing. You know, broadband. This is a yes or no. Is broadband important for us to be engaged in this digital currency world?
Yes, although offline usage is also an area that will be important to explore for areas that don't have good coverage.
Well, and good coverage is the operative word. You know, as we weave in other things, let me remind everybody who didn't necessarily support the infrastructure bill that as we move forward, broadband was a part of it. So as we keep coming back, we need to think about that in relationship to how we survive financially. Thank you.
Okay.
In fact, I'm not sure what my time period is. So I yield back, Madam Chair.
Thank you, Ms. Beatty. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Dr. Brainard, for being here and sharing your thoughts. I want to go back to, you talked about with Mr. McHenry, two of the benefits to a CBDC being avoiding fragmentation and then instability. And you cited the recent instability in the stablecoin market as your example for that. Just so we have a base level of understanding, would you agree that one, the stablecoin that broke and basically went to zero, that was backed by low quality assets, or at least volatile assets? Would you agree that that was an algorithmic stablecoin, not backed by fiat currency in any way, shape, or form? You would agree with that,
Here's
correct?
that way. Yes.
Okay. Would you also agree that the other one that you cited that broke the peg for a period of time, it does not have the same transparency, or isn't as transparent from an asset quality standpoint as maybe we would like in an ideal world? Would you agree with that? Okay. Would you also agree that another prominent stablecoin, which is more transparent and claims to have higher quality assets, that did not break the buck, correct?
Yes.
Okay, so tell me if this leads you to the conclusion that it leads me to, which is a well-regulated stablecoin where we have high standards for quality of assets, liquidity, transparency, where we really tighten the definitions around what a stablecoin is and what it can hold, would solve for the instability issue that you cited.
It will solve a very robust set of regulations, akin to bank-like regulations, would solve for bank-run type of instability. Yes.
So again, quality of reserve, I think we'd probably disagree on the sort of scope of that, but quality of reserves, liquidity, transparency, redemption rights, these are the sorts of things we should be talking about when we're talking about well-regulated stablecoins.
Yes, it won't solve the fragmentation problem. It won't solve the interoperability problem. It wouldn't solve the potential.
I want to get to that fragmentation point for a second. So you also said that you are in favor of a world where we have coexisting alongside of each other, CBDCs and stablecoins. When you say what you just said about all these other problems that don't get solved, but then you say that you're for this coexistence, help me understand why that's not speaking out of both sides of your mouth a little bit.
Let me just say first that I haven't said one way or the other. I think the decision about whether to issue a CBDC lies in the future. So it's really in that world. I would see a CBDC as potentially complementary. And
So let me just ask real fast. Sorry, in a world where we have well-regulated stable coins and there's various providers, you've said that is. That leads to fragmentation. So help me understand why that world plus a CBDC, in your view, doesn't also lead to fragmentation. Like, how are we less fragmented if you're in the camp of saying I'm for both coexisting? You're muted, I believe.
yeah, the currency that is backed by the full faith and credit of the U.S. government naturally provides interoperability between different platforms. And so in that kind of a world, you'd still have a digital asset that would have the backing of the US government and therefore would naturally be that kind of neutral settlement asset layer. And different stablecoins could then, have different attributes and be part of different ecosystems, but you'd have that basic interoperability built in.
Yeah, I guess I'm having trouble still understanding how, in your view, these could coexist and there not be fragmentation. But I'll set that aside for a second. My final question with 20 seconds, the reserve currency status. Have other central banks reached out to your team and expressed concern from a reserve currency status if the US does not have a CBDC?
Other central banks have certainly asked us to participate in some of their work in the hopes that the U.S. Would
Specific to the
maintain.
reserve currency status question?
Well, specific to being one of the most important central banks that is values privacy and transparency and a set of values around digital currencies that they share.
Thank you. I yield back.
Thank you. The gentleman from Illinois, Mr. Caston, who is also the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chair, and I'm really enjoying this conversation. Thank you, Vice Chair Brainard, for taking your time today. I want to start with just some structural issues that I'm still having a hard time getting my head around this as long as we've had these conversations. For a US CBDC, my understanding, and correct me if I'm wrong, just yes or no, is that for that to work, it always has to be a liability of the Federal Reserve. Is that understanding right?
Yes.
Okay, so if that's the case, does that not mean that from a money supply perspective, it's always limited to M1 money supply? There's no multiplier effect. The banks can't lend against deposits. It's always limited to just an M1 money supply issue. Is that essentially right?
It would be akin to cash. It would be the digital analog of cash currency.
Okay, so I asked that because, and I'm getting to a larger question, so we'll get there, but I'm hard pressed to think of how a private bank would ever have a specific incentive to take CBDC deposits. I can't imagine the interest rate that gives them the same incentive that they would have if they can lend against deposits. What is the case for why the private banking sector would find CBDCs valuable in their business model?
So banks are very important in payments. Consumers are moving away from, to some degree, using their deposit accounts for payments. We've seen that kind of growth in some of the leading mobile payments apps. And so I certainly don't know. Again, I think the reason that we're trying to think in the future about this is because we don't actually know how the financial system is going to evolve. But I would imagine that banks would continue to want to be very active in the payment space and see this as an important service.
I'm not raising these as criticisms of your work or our work. It's just that I understand that as an intermediary of money charging fees, different types of currency are fungible, but the opportunity to make money in a bank, if I deposit $1,000 and the bank can lend out 800, I can't see that opportunity existing in a CBDC space, and that's such a huge engine, not only of the bank's incentive, but our economy's incentive. Let me shift if I could, and I'm still going to get to the bigger question here if I don't run out of time. Let's talk about stable coins that are not CBDC stable coins. In a world where we have satisfied that there's no differential, money laundering advantage or payment time advantage, is there any reason why a stable coin doesn't fundamentally present the same liquidity and risk issues as a money market fund does, and shouldn't have the same sorts of protections around it from a depositor investor protection perspective?
Yes, you could think about it as a money market fund, or you could think about it as requiring even higher protections as a kind of tokenized deposit. But yes. Okay.
So the reason that I'd ask those questions, and I don't mean this to sound like a leading question, but I'm struck that I think I'm somewhere between Congressman Himes and Congressman Sherman. I love the new technology. I think there's sex appeal. I think we should embrace these things. I also agree with Mr. Sherman that there's the potential for a lot of grift on these devices because they are so sexy and they're attracting a lot of relatively unsophisticated money. Do you have a view, whether from where you sit as as a vice chair or FSOC or otherwise, that if we have this thing that is very technologically sexy, lots of people are coming into it. There are sophisticated players that are taking advantage of it. do we have enough visibility into the transactions that are going on in these markets, whether inside the exchanges or inside the wallets, to ensure that people are not essentially running a whole lot of pump and dump schemes, for lack of a better word, or taking advantage of insider information? Do we have enough regulatory protection to understand what's happening there? Because I have a concern, and I'd love your thoughts in the time we have left.
We certainly don't at the Federal Reserve, and I'm guessing several of the other financial regulators might share that concern.
Well, I'd love to follow up in the offline, because it scares me that feels like a lot of what's driving the volatility in the space. It scares me if we don't know how to actually identify how big a deal that is. I see I'm out of time. I yield back. Thank you for your thoughtful responses.
Thank you very much. The gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
I believe you may be on mute.
Mr. Loudermilk, are you unmuted? No, he's muted. We'll go on and then we'll get back to him.
Mr. Bud.
Hey, can you hear me?
We need to replace. I'm waiting. Yes.
Can you hear me now?
Yes, I can hear you.
Okay. I'm not sure what was going on. It was off mute. So
All right. Thank you.
I apologize. Thank you, Madam Chair, Vice Chair Brainard. Thank you. I'm sorry for the little technical glitch, but that's what happens when you're still doing things remotely. I know this has been touched on, Vice Chair, but I think it's very important. And I want to make sure we have a clear understanding in Congress about the CBDC white paper and the intention of the Federal Reserve to potentially move forward. And as I'm sure it's been stated, that the white paper states that the Federal Reserve does not intend to proceed with issuance of a CBDC without clear support from the executive branch and from Congress, ideally in the form of a specific authorizing law. That is a very loosely worded phrase in my estimation, is that the Federal Reserve does not intend to proceed with the issuance of a CBDC without clear support from the executive branch and Congress, ideally in the form of a specific authorizing law. So could you touch on or confirm that the Fed won't proceed with a CBDC without specific authorizing law from Congress? Or what's the intention?
Yeah, no, I think the intention is just as you described it, that we don't intend to proceed without the support of the executive branch and Congress, and it would be ideal to have authorizing legislation that's specific to this, and it's really as simple as that.
Okay. If there wasn't authorization in the form of an authorizing law, which would indicate clear support from Congress, but if there wasn't an authorizing law, would there still be an intention to move forward in some way?
I think we really want to see that support coming both from the executive branch and from Congress.
I apologize. I think somebody's still unmute.
Yeah.
Okay.
So I just said that we certainly want the support from the executive branch and Congress before moving forward on actually issuing a digital dollar if the decision were taken to move in that direction.
Okay. Well, we'll keep an eye on it, because it's still the word "we don't intend" leaves a lot of ambiguity there as far as I would like to hear that we're not going to do it without, but understand what you're saying. So we'll keep an eye on it. Move on to another subject. One of the Fed cited reasons why a CBDC could be helpful is that about 5% of households are currently unbanked. But the FDIC's data indicates that many of those simply do not want a bank account for various reasons. So, really, a massive government undertaking with a CDBC would be vastly out of proportion with the relatively small scope of the problem. So, in my mind, Fed issued digital currency alone would not help the unbanked because if they want to be unbanked, they'll stay unbanked. CDBC would have to be paired with some Fed sponsored checking accounts to actually have an impact on that. And I think that would be a wildly misguided idea. So our our payment systems are already that they already work well for the most part. So the best thing to do is to make improvements to the existing system rather than just completely overhaul it, in my estimation. But another concern with a CDBC is cybersecurity, which is something that I've been very interested in since I've been in Congress coming from the IT sector. The federal government is probably the single biggest cyber risk, and virtually every federal agency has experienced a data breach. So my question is, if the Fed ever did proceed with a CDBC, it would be catastrophic if cyber criminals were able to manipulate our currency. So how could you ensure that it would be protected against cyber attacks?
Yeah, so operational and cybersecurity risks are an ongoing challenge for all payment systems, and I think any digital dollar would be the same. And of course, we already are responsible for providing critical pieces of the wholesale payments infrastructure and the retail payments infrastructure. We provide it both to the public and to the government. I would just call your attention to FedWire, to Fed ACH, and of course, we're working on FedNow. So we already have really important responsibilities in the payment system in collaboration with and support of the private sector, and we already have very significant cybersecurity responsibilities there. And we recognize how important those risks are and how important operational resilience is.
All right.
Thank you.
Thank you, Madam Chair. I yield
Gentleman's
back.
time has expired. Thank you. The gentleman from New Jersey, Mr. Gottheimer, who is also the Vice Chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you so much, Madam Chairwoman. Thank you, Vice Chair Brainard. It's good to see you. Thanks for being here to discuss digital assets and Federal Reserve's research on central bank digital currencies. Vice Chair, as you know, many Americans already storing their hard-earned dollars in privately issued digital assets like stablecoins, as we've been talking about today. While some stablecoins are less stable than others, I believe it is possible to establish guardrails to ensure Americans can distinguish stablecoins that are backed one-to-one with liquid assets from others that have questionable or non-existent financial backing. My draft legislation, the Stablecoin Innovation and Protection Act, would establish a definition and requirements for qualified stablecoins. And in the bill, qualified stablecoins are defined as cryptocurrencies redeemable one-to-one for US dollars. This legislation would reduce financial instability in markets, protect consumers, and support innovation in American fintech. It would also create a pathway for both banks and non-banks to acquire a qualified status for stablecoins they issue. With federal oversight, do you believe non-bank entities can be reliable issuers of qualified stablecoins if they can prove they're fully backed by cash or cash equivalents?
Yes.
Excellent. And if a system of qualifying stablecoins were implemented, what specific guardrails would you like to see in place for non-bank issuers?
Well, I think that the President's Working Group put out a variety of requirements that would be important. Now, of course, they're focused on bank issued stable coins, but I think any set of stable coins would need to have a similar, very strong set of protections regarding assets, the actual consumer protections, investor protections, transparency, cybersecurity. I mean, there's a very important list of protections that would be very important for a stable coin to be able to redeem at par reliably and to not be subject to consumer and investor fraud and other kind of protection concerns.
Thank you so much. I appreciate your insight and looking forward to continuing the conversation there. I would like to shift, if it's okay with you, a bit to discuss the need to support continued innovation in digital assets. In the Federal Reserve's recent paper, Money and Payments, the US Dollar in the Age of Digital Transformation, the Fed explored the potential benefits and risks associated with issuing a central bank digital currency, as you've also obviously been addressing. The technologies that support digital assets are rapidly evolving, as everyone knows, in this area of finance has been a great source of innovation in recent years. And if one were established, how do you see CBDC interacting with privately issued digital assets like stablecoins?
Yeah, so I think that the having a digital currency that is backed by the full faith and credit of the U.S. government as currency is unique and would be unique, and could be actually an important support to a broader system of private sector innovation, much as the Federal Reserve today, the payment services it provides and the issuance of currency it provides undergird private sector innovation. So, in the comments we've gotten back from innovators and payments providers, they really talk about the potential for a digital currency issued by the central bank to provide a neutral settlement asset, a neutral layer in the technology stack that would enable interoperability and be a stable underlying neutral asset.
Thank you for that. I appreciate it, and for your work. And I yield the remainder of my time. Thanks.
Thank you. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
I thank the chair. Vice Chair Brainard, thanks for being here today to discuss the Fed's plan for CBDC or the digital dollar. So historically, the federal government has not had the best track record when it comes to innovative thinking versus the private sector. Government innovation seems like sort of an oxymoron, if you will. So here's what I want to know. What's the Fed trying to achieve by issuing a CBDC that the private market hasn't already been able to do? Here's why I ask. It's because when I look at private sector innovations like stablecoins, I already see that many of the claims of CBDCs being achieved by stablecoin providers. For example, like USDC, US dollar coin issued by Circle.
Yeah, so first of all, there's no decision that's been made. We're really exploring this topic, and there are risks of action, risks of inaction. But the U.S. Federal Reserve uniquely can issue currency that's backed by the full faith in government. Of course, no private entity can do that. So it just plays a different role. And I think what Congress has always asked the Federal Reserve to do is to play a role alongside the private sector. That's why we have really important payment systems like FedWire. And I think there's general recognition that when there is a completely secure, trusted asset that underpins the system, private innovation can actually be stronger and more robust. And so that's really the question here is whether by being that neutral settlement asset, that foundational layer, it might actually lead to greater ability for the private sector to add value and innovate.
So Vice Chair, thanks for that. So there is some possible outcome where the Fed would say, you know what, they don't need to do anything. The private market just has this handled. You could see that possibly being an outcome.
Absolutely. I think that it would simply be different, going into the international payment space with a stable coin as the kind of dominant digital form of the dollar when other central banks from other countries issue from their central bank their digital currency. That's just a really different approach. But it's certainly one that some people would favor.
So, Vice Chair, what's got me most on edge or concerned about this is the Fed and the Fed issuing CBDC are the concerns around financial freedom and privacy. So privacy and the lawful use of money without Big Brother keeping tabs, it's a universal right. So I'm not convinced that a centralized digital payment system issued by the government would fully protect users' privacy. So what steps would the Fed take to prevent government from monitoring Americans' financial transactions or prevent certain legal, with an L, legal transactions from occurring that the government deems high risk or that the government just doesn't in general support?
So privacy is a huge issue. It's incredibly important. And that's why the discussion paper that we put out in January says that one of the core principles of any such digital currency, digital dollar, would need to be privacy protected. And so what the paper talks about is an approach that's just like your bank deposits today, that there would be no direct connection between the Federal Reserve and consumers, that it would be an intermediated system. Banks could play the same role they do now with they having the transactions records, having obligations in terms of the privacy of those transaction records, and being responsible for verifying identities.
Where
So it
is
really wouldn't be any different from the
man?
system we have today
I mean,
in that regard.
Thank you, Vice Chair, and I yield back the time.
Thank you, the gentlewoman from Massachusetts, Ms. Presley, who is also the Vice Chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thank you, Madam Chair. The creation of a digital dollar is certainly a hefty responsibility. This technology, if properly designed and administered, has the potential to promote financial inclusion, enhance consumer protection, and completely revitalize our public payment and banking services. Today's hearing is on a CBDC, but I do want to begin by highlighting the currently outdated payment system that brought us here, when families still have to wait days at a time just to access their own hard-earned money. While the UK switched to a real-time payment system back in 2007, the Fed delayed action for an entire decade. And the FedNow system is not expected to be implemented until at least 2023 or 2024. Vice Chair Brainard, this delay by the Fed has had devastating consequences for working families, and some would argue has contributed to many people turning towards riskier systems like cryptocurrency, stablecoins, and other private options in search of faster payments. Why should we trust the Fed with the responsibility of designing and implementing a CBDC? Given the Fed's track record, is it safe to trust the Fed with this responsibility? And how do we know this project would not face the same decade-long delays?
Well, I think the Fed now is going to be very important in terms of offering real-time payments. I agree with you that from the perspective of those small businesses and families that need access to their funds the most quickly, real-time payments can have the largest effect. FedNow didn't get started for a long time because of public debate of the nature that we're having here today. We are a public institution, so unlike a private institution, there needs to be support from Congress and broader support among a whole variety of stakeholders. And so that is why FedNow took some time to get that kind of support and get off the ground, but we're now on track to deliver it this time next year. And the private sector is quite excited about it at this juncture, although there was a lot of ambivalence in the lead up to that announcement. And I think it's a really important analog to today. The financial system is moving very rapidly. It's very hard for us to see 5 years out. If we wait until 5 years to decide to launch, it'll probably be another 5 years before we could actually deliver. And so that's why we think it's really important to do that work, just to be prepared.
So sorry, I have a couple other questions I want to get in, so I'm just going to reclaim my time here. I mean, I think the point here is that many countries have been able to set up a real-time payment system much more quickly and efficiently than us, and it is critical that our nation is meeting the evolving needs of the digital economy. And let me be clear, the Fed is not and has never been the sole federal entity responsible for issuing currency or administering public payments. The Mint issued coins, and the Postal Service provided postal banking services for decades until it was shut down. Today, Treasury's Bureau of the Fiscal Service partners with banks to issue prepaid debit cards to millions of unbanked and underbanked individuals. Vice Chair Brainard, do you agree that instead of expecting the Fed to solely shoulder the burden of determining any kind of CBDC architecture, we should be bringing in other key agencies and actors into this process from the onset that are proven?
We do partner with Treasury on those prepaid cards. We do partner with other agencies. We provide a lot of the services in the rail. So yes, we are in partnership with a variety of agencies. So yes, agree with you.
Well, that's good to hear, because as we evaluate how to design and build our digital currency architecture, we should be involving other public agencies like Treasury, the Postal Service as well. The design and implementation of public digital money will affect everyone, and it is imperative that this process be as inclusive and as democratic as possible, with an explicit focus on financial equity and establishing faster payments while safeguarding communities' right to privacy at the same time. Thank you, and I yield.
Thank you very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chair Waters and Ranking Member McHenry, and thank you, Vice Chair Brainard, for being with us today. The Federal Reserve, in its discussion paper, included a request for public comment on several questions on design considerations, as well as on the benefits and risk of the Fed-issued digital currency. One question asked, for example, if cash usage declines, is it important to preserve the general public's access to a form of central bank money that can be widely used for payments? A few responses that you're probably familiar with from commenters include, one, that is a loaded question, stop phasing out cash. Another, cash is king. Leave cash alone. Some form of cash will always be necessary. We should always have access to non-digital forms of currency. Yet another, there will always be a need to use cash. And finally, we should always have access to non-digital forms of currency. Vice Chair Brainard, following up on a line of questioning from Ms. Beatty earlier, if the use of cash declines or continues to decline, I might say, how would individuals in areas that lack access to broadband utilize a central bank digital currency?
Well, first, let me just say, we are absolutely committed to continuing to issue currency, and we've got a lot of investments in providing cash. So we're really just going to respond to consumer preferences there. But we couldn't agree more that it's very important for access to cash, whether there may be less acceptance of cash in payments over time. That's not something that we would obviously have any control over, but we're certainly providing cash, and we think it's very important to continue to do so. In terms of rural areas that may lack connectivity, one of the areas of research is to think about offline transactions, stored value cards. So it's a very important set of considerations about making sure that if there were some kind of digital currency, there would be round-the-clock access, including offline.
And you've touched on my next line of questioning, which, Vice Chair Brainard, are there any work streams underway or analysis being done that you could comment on the ability to issue CBDC and maintain an offline option for payments and transmissions? And could you comment on those?
Yeah, it's one of the work streams. It's certainly something that we're also in collaboration with some of our peer central banks who are very focused on this issue as well. Obviously, for this to really be an inclusive form of payment, there need to be solutions that address offline usage when the access to the internet is low or non-existent.
Another question in the Fed's request for public comments was, are there additional ways to manage potential risks associated with CBDC that were not raised in this paper? The responses included things like keep politics out of monetary policy, the potential risk of corruption and abuse of centralized power and control over all economic activity is too great. And then another, once the door to the kind of power a CBDC creates is open, it will be abused. And then finally, simply don't do it. Vice Chair Brainard, we saw how dangerous it can be when the government weaponizes the financial system for political purposes under the Obama administration's Operation Choke Point. More recently, the Canadian government instructed banks to freeze accounts linked to the trucker protests over vaccine mandates. Vice Chair Brainard, without appropriate safeguards, would a CBDC make it easier for the federal government to block individuals it disagrees with from accessing the financial system?
So I really don't see a CBDC as raising questions that are different from, deposits in bank accounts, for instance. And the paper that was released in January, in particular, talks about an intermediate model akin to what we see with commercial bank deposits, where the central bank doesn't have any direct interaction with consumers, doesn't see transactions by consumers, but there are intermediaries, very importantly, including banks, that would be responsible for both identity verification and for keeping that transaction data private. So in that sense, I don't see it as really any different than the issues that are raised with commercial bank deposits. And, privacy is one of those areas that I think is most important to think really hard about. We asked some really important questions there. We got some good answers.
Thank you, and I appreciate that insight, and I hope to hear more going forward. I yield back, Chair Waters.
Thank you. The gentlewoman from Michigan, Ms. Talib, is now recognized for 5 minutes.
Thank you so much, Chairwoman, and thank you, Vice Chair, for being with us. I know, given the reliance of electricity and internet access for a functioning central bank digital currency, many folks are not touching on the impact of climate, and really truly believes, the CBDC must take into account severe weather events and climate change impacts. So over the last several years, I've been alarmed at companies like Greenwich and them reactivating a coal-fired power plant solely for the purpose of mining energy-intensive proof of work-based cryptocurrency. When our communities are flooding and our forests are burning, this is simply a huge step in the wrong direction and cannot be a viable model going forward, particularly for CBDC. So, Vice Chair, how is the Fed approaching these challenges when developing a CBDC?
Yeah, so I think the proof of work that is needed as a consensus mechanism in some forms of blockchains are extremely energy intensive, as you say. Any kind of system that's permissioned where you have a central ledger or a central authority like a central bank doesn't require that kind of very energy intensive consensus mechanism because there is a trusted.
So how is it, Vice Chair? So we got these environmental concerns, and you're talking about regard to proof of work. So how are we addressing those environmental concerns through the?
Yeah. So any kind of system that would be run by the central bank, or where the central bank would be the central authority in terms of who can issue, would be like our existing payment system. It would not require those consensus mechanisms that use up all that energy, because all these servers would have to be involved in establishing that a transaction had taken place. So it really wouldn't be very different from our existing payments infrastructure, which doesn't require that kind of energy intensity.
As you probably know, I represent the third poorest congressional district in the country, is significantly unbanked and underbanked population. And so throughout the pandemic, I saw how difficult it was for many of my neighbors who lack access to traditional banking services to receive their stimulus checks or collect unemployment insurance. And our, traditional banking ecosystem really failed them precisely when they really needed the money the most. So I understand the appeal of digital assets and better payment systems. However, the Fed's current CBDC proposal currently requires the use of a bank account. And earlier today, you noted that you do not believe the Fed has the authority to authorize direct accounts for individuals. I mean, Vice Chair, can a digital dollar truly function, as you mentioned, as, quote, a cash analog, end of quote, while using this intermediate whatever model? How can we make sure that we're removing barriers to financial inclusion, not shifting them around?
Yeah, so I think what a central bank issued digital currency can sort of help with is reduce transactions cost and real-time payments. What it would need to also see in order to really make a dent on this very important underbanked and unbanked problem that we're all very concerned about is there would have to be other partners, I think, who either nonprofits or public partners who would be able to be that intermediary. And of course, banks are also now starting to offer or are offering bank on accounts, which are low cost accounts. So
Yeah, I know. It's just,
banks
I
could
was,
also do that.
yeah. And Vice Chair, I've said this to my colleagues on financial services. It's not for free to bank with these institutions. It actually costs money, and that is sometimes the biggest barrier, right? So it is, if I have time, Chairwoman, I don't know if I do, but I know earlier this week the Fed's 2021 report on the economic well-being of U.S. households found that low-income and underbanked users were more likely to use cryptocurrency for transactional use, for obvious reasons because of those barriers, while high-income users were most likely to use crypto purely for investment purposes and typically had other retirement funds. So I'm really concerned that many individuals who are currently using cryptocurrency solely for financial access have no choice but to expose themselves to highly volatile ecosystem. Are you guys addressing that risk?
So that was a very important finding in this survey. And I agree with you that it would be really important not just to have banks as intermediaries, but also to potentially have other kinds of intermediaries whose business model might be specifically to provide that bridge to consumers who currently, for a variety of reasons, are not comfortable with bank accounts.
Thank you.
Thank you very much. The gentleman from Wisconsin, Mrs. Style, is now recognized for 5 minutes.
Thank you, Madam Chair. Vice Chair Brainard, thank you for being here today. A lot of the conversation today seems to assume that the ease of use of other countries' CBDCs poses a threat to U.S. dollar dominance in the future. And while I recognize the sophistication and liquidity of our financial markets enhances the utility of the dollar worldwide, I think a big part of the dollar's appeal as a reserve currency is the strong, stable position of the United States. With that in mind, I'm becoming more and more concerned about the worsening fiscal position and how it'll threaten the U.S. dollar's central role in global finance. In its budget and economic outlook, the CBO projected the growing danger posed by rising interest costs. We've taken a lot of debt on. We're running persistent deficits. Meanwhile, interest rates are rising, and by all indications are going to continue to rise. And so I think it's relevant for the committee just to take stock that, for reference, the last time inflation was this high, about 40 years ago, the yield on the 10-year note was around 11%. We're not close to 11% today, but most forecasters, including the CBO, expect the cost of debt to continue to rise. In fact, the CBO projections show net interest costs rising from about $400 billion this year to nearly $1 trillion by the end of the decade. And this, I think, is the number one issue that we should be discussing. in particular as it relates to maintaining the supremacy of the United States dollar as our global reserve currency. And so with that in mind, with that kind of construct, Vice Chair Brainard, over the course of today's hearing, I've noticed that a lot of the disagreement about the structure of the CBDC stems from our different views of what problems the CBDCs are supposed to solve. We've kind of heard financial inclusion, we've heard other things discussed today. And I think one thing that's of note is in the FDIC's survey of how Americans bank, 36.3% of unbanked respondents said they didn't have a bank account because they simply don't trust banks. So 36% said they avoided banks for privacy reasons. 19.6% said banks don't offer the products or services they needed. It's not obvious that a CBDC would necessarily inherently solve these problems. So I would like your input here from with a global perspective. Other countries are exploring a CBDC. Specifically, what problems are other countries attempting to solve through their implementation of a CBDC?
Yeah, so I think it does, there are a variety of motivations. Financial inclusion is certainly among the problems that some other jurisdictions are solving. There is a declining use of cash that is a very important motivation among several peer central banks, and the focus there is on making sure that consumers, households still have direct access to safe central bank money as the use of cash as consumer preferences and business preferences decline regarding cash. There are also the motivation of concern about fragmentation of the payment system and potential instability associated with the increased use of stable coins. And of course, there's also concern about the very opaque and costly nature of cross-border transactions. So those are just a quick summary. Yes.
Understood. But have they achieved any of these early goals? So let's just take financial inclusion for a minute, because it's a topic we spent a lot of time working on, thinking about. I think it's appropriate to discuss. As I noted earlier, many of the reasons folks are not banked in the United States is privacy concerns. I think made worse by the proposals of this administration to see aggregate inflows and outflows of Americans' bank accounts. Have countries seen any other countries, for our own lessons, have they seen any success with those stated goals? For example, financial inclusion?
So I think it's a little too early to assess that. The central bank digital currencies that are being issued in foreign jurisdictions are quite recent, and other countries are in the process of developing but have not yet issued. Some jurisdictions have seen some really big improvements in financial inclusion through the use of a government-provided payments app, interestingly. So there's a lot of focus, for instance, on Brazil in that regard. And there you have seen a really big increase in financial inclusion.
I appreciate being here, cognizant of the time, Madam Chairwoman. I will yield back.
Thank you. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Madam Chair, and to the Vice Chair today for being here. I want to, of course, talk about the use of digital assets and payment technologies, and as they continue to grow and integrate into our daily lives. It's important that we offer safe and efficient digital tools and assets that will protect consumers and maintain financial stability. I applaud the Federal Reserve for taking the next steps toward improving U.S. payment systems so that vulnerable customers are not left behind in the digital age. Vice Chair Brainard, I recently co-sponsored the eCash Act introduced by my colleague, Mr. Lynch of Massachusetts, which directs the Treasury to establish a 2-stage pilot program to develop and issue an electronic version of the US dollar, eCash, for use by the public. The bill has a major financial inclusion element because eCash will not require the use of a bank account. According to the FDIC, over 7 million Americans are unbanked. The eCash Act ensures that
those who rely on physical cash due to mistrust or lack of access to traditional financial services will have the option to use eCash, allowing users to facilitate online payments and access to the digital marketplace. Vice Chair Brainard, as the Fed considers its central bank digital currency design, it seems that the Fed has a two-tier system in which a consumer would need to go through a private banking institution to access a central bank digital currency. How will the Fed work to ensure that all consumers have access to a central bank digital currency, specifically the unbanked and underbanked population?
Yeah, so I think that financial inclusion question is one that we have and will continue to focus on in our research. You know, my sense is that because of the concern about privacy and wanting to have an intermediated solution here, or at least if we were to go in that direction, our paper recommends that the question about who might those intermediaries be becomes very important for financial inclusion. And again, you know, the private sector can do a lot of innovation in this arena. So, you know, if you have a payment asset which is low cost to use and, you know, where you have immediate settlement, there are likely to be nonprofits who may, or other private intermediaries that may innovate on top of that in order to reach underbanked consumers. And of course, it's also true, as in your suggestion, that other government agencies might be quite relevant there. But it's not the tradition of the Federal Reserve, and statutorily we're proscribed from directly providing those accounts.
Thank you, Dr. Brainard. I'd like to shift gears briefly and discuss the use of stablecoins for remittances. As you know, Facebook failed in its attempt to use its own stablecoin in 2019 after this committee and other policymakers raised serious consumer protection, financial stability, and consolidation of economic power questions. However, in 2021, Facebook launched a much narrower digital wallet pilot program called Novi, which would facilitate remittances using a stablecoin called Paxos Dollar. While Paxos Dollar is not an algorithmic stablecoin, I worry that there's a potential for the Paxos Dollar to lose its alleged dollar peg, like we've seen with the algorithmic stablecoin Terra. In fact, Tether, the largest stablecoin, briefly lost its peg, as you know, earlier this month due to this month's crypto crash. Would a U.S. central bank digital currency provide the potential for a safer and lower cost alternative to remittances?
Well, remittances is one of the use cases that I think is cited most often in terms of the potential benefits of a digital currency. That's certainly the main motivation of some foreign central banks in moving to issue a digital currency is for remittances. And as you know, remittances currently, it's very, very costly. It's opaque and slow to make international remittances. So yes, that is one of the areas that is seen as most fruitful potentially.
Thank you. My time is up. Madam Chair, I yield back.
Thank you. Thank you very much. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes. Thank you, Madam Chair, and thank you, Vice Chair Brainard, for being with us today, and congratulations on your recent confirmation. I want to build on what my friend Congressman Stile just touched on. I believe it is more critical than ever that we maintain the dollar as the global reserve currency, but the current state of the U.S. economy with skyrocketing inflation, our $30 trillion debt, and an increasing erosion of the confidence of our position as a global leader are all causing some to bring into question the future of the dollar. Just a few years ago, most would argue that there was no real alternative to the dollar, but these conversations have now begun to gain traction. Recent events have brought forces to bear that could speed up a potential alternative. China is working tirelessly to challenge the dollar, and they are playing the long game. Their Belt and Road Initiative has given them considerable leverage
especially among developing countries all around the world. That, combined with filling the vacuum created by US and EU financial sanctions on Russia and Belarus, gives China the possibility of challenging the dollar far sooner than we may have expected. As the chairwoman just said, trust and confidence in the US institutions provide the global community the ingredients to maintain the dollar as a global reserve currency, but China can possibly browbeat their way past the necessary trust to get a large portion of the world to abandon the dollar. And this is extremely concerning to me. Additionally, the recent CBO report that came out showed our national debt will continue to skyrocket to unfathomable levels in the coming decades. Their report tells us that the debt will be 110% of GDP by 2032, an all-time record, and will reach 185% of GDP by 2052, 30 years from now. This is all driven by a staggering $72 trillion of spending over the next 10 years, 11 trillion more than the CBO projected in February of 2021. Admiral Mike Mullen, in 2010, when he was the chairman of the Joint Chiefs, said that the greatest threat to our national security is Congress's inability to spend within its means. And we had 11 or 12 trillion dollars in debt then. And here we are, we're talking about tens and tens of trillions more in debt just in a few short years. In my opinion, this is the single greatest threat to maintaining our global position. The world needs to be able to trust that we can continue to pay our bills, and the CBO report paints a picture that will make it much harder for us to continue to make that argument. So my question is this: do you agree that debt is the greatest threat to maintaining the dollar's current status as the world's global reserve currency? If not, what is? And how would a potential Fed-issued CBDC play into this discussion?
Well, I think the U.S. status as a reserve currency is reflective of a host of things. The resilience and dynamism of our economy, the depth and liquidity of our financial markets, the trust in our institutions and our legal system. And so when you think about other, residents from around the world, why would they wish to invest in the dollar? All of those things go into it. And certainly, I think that fiscal sustainability is a piece of that picture. But we do have a very dynamic and resilient economy, as we've seen just in the last few years. In terms of the payments dominance of the US, and that's really the piece that I think a digital currency goes to. The payments dominance of the US is not something that we can take for granted. As you noted, there are other countries who would prefer not to be using dollars for international payments and who would wish to be moving away from the kind of international payment system that is very centered around the US dollar. In that context, if other central banks issue their own digital currencies, it is very important for the US to be at the table, have an important leadership role at the table in determining standards for those kinds of cross-border transactions. And it may be very important for the US to have its own digital currency offering. That's a question. But I think it's an important question that we should just keep in mind as we're thinking about the pluses and minuses of the potential future state of the US and global financial systems.
Thank you for that answer, Madam Chair. I yield back.
Thank you. The gentlewoman from Texas, Ms. Garcia, who is also the Vice Chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Madam Vice Chair, for being here with us today. And so we discussed the implications of creating a digital currency. And I'm not going to call it the fancy CBDC because, frankly, a lot of viewers who are listening to us probably don't understand what that means. So I'm going to just talk about generally the digital dollar equal to our dollar. So if cash is king and the dollar is king, then the queen that's equal would be the digital dollar. And I don't mind, for one, that we have some little prince and princesses around the king and the queen, whether it be cryptocurrency or debit cards or anything else. I just think we need to make sure that whatever is out there, that, as Mr. Scott, my colleague, said earlier, that everyone is brought along and that everyone is included. I know one of my colleagues said that we're all enslaved to the phone. Well, some of us are not. I know I'm not. I still have a checkbook and I still keep it and maintain it. And I have a debit card that I was issued by my bank that I almost never use. So one will not fit all. So we're going to have to keep the options. When do you see, and I find 5 years a long time to develop this, that quite frankly, I'm not sure that China or the Bahamas took that long. So now my first question is, how long will it really take? And then how will we kind of wean off or balance and make sure that we have the different options for people?
Yeah, so the truth is, I don't know what the right number of years is. It really depends on where we are in that decision process. But the piece that takes the most time.
I want to go ahead and stop and interrupt. So where are we in the decision process? Because I'm a little frustrated and I'm here toward the end. I've sat here and listened to all of it. It seems that when we had the Fed chairman here, he kind of pointed the finger and said that he was waiting for, the Treasury Secretary to say something. Then she came in and she said, well, they were waiting for the working group. Well, the working group came in and they said, well, we need something from Congress. Where does it stop? Who is going to decide and how long is it going to take? Because we don't want to have you back here and say, where are we? We're having to catch up. Where are we on this? And tell us what the roadmap is.
Well, we have put out a discussion paper, but of course, Congress has this really important role to play. And so, we, as we've said, we would like, in making that decision, clear support from both the executive branch and Congress. So let me just put that aside because that's really all of you. In terms of other countries that have built, it probably took China about 6 years to go from their decision to a pilot. What I have said I think is important is that while the public debate and discussion and education are really important and need to take the amount of time that's appropriate, we can be doing some things at the Federal Reserve, and that's what I'm hoping that I can and my colleagues at the Federal Reserve can move around. So if you were in Congress to make that decision, we would be further along in that process. So we wouldn't be starting, from the first day, but we know a lot about those policy design questions and technology build questions. So that's the piece that I think we can help with.
And you keep talking about stakeholders. Could you define that, what that means? I mean, are you talking to consumer groups? What consumer group is at the table? What minority groups are at the table? What women's group? What group representing rural America? What groups representing just poor people who have little access to cash, but actually don't even depend on checkbooks either. They just go cash to check, paycheck to paycheck, and I deplore payday lenders. So who's at the table? Because if we're not at the table, well, then we're not going to be a part of the result.
Absolutely. So part of the reason in our system this is a long process is because we have a very rich set of stakeholders. We got comments. That's our first step is soliciting comments, and consumer groups did solicit important comments. Payments companies, tech companies, banks. We got a rich set of comments, and now we're kind of systematically and going through and making sure we do reach out, particularly to the underbanked, to rural areas, to those who not otherwise.
Chair, I don't believe that witness answered my question. I want to know who's at the table at consumer groups. So who is it? Is it the Consumer Federation of America, or are the credit unions at the table, or the community banks at the table? I think I'm struggling with trying to find out just where we are in this process. And I was hopeful that we would get some answers today. With that, I yield back.
Thank you very much.
I'm happy to go through. We've talked to the National Consumer Law Center.
We will follow up. We will follow up.
I have a whole list here for you if that would be helpful.
Okay. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair, and good to see you again, Vice Chair. I want to follow up a little bit on a couple of my colleagues, actually on the other side of the aisle. Mr. Himes expressed his view that the benefits of a digital currency are quite clear. I imagine you've had a chance to review the letter that Republicans from our committee sent and the questions and concerns highlighted throughout. The crux of the question that Mr. Himes was referring to is whether or not the obstacles in our payment system could best be addressed by a centralized digital currency. And since since it's obvious, I'm curious, do you believe that is the case or not?
So the kinds of issues that a central bank digital currency is uniquely able to solve really go to having the full faith and credit behind the issuance of currency. We have that now in physical space. We don't have that in digital space. The financial system is moving extraordinarily rapidly to a primarily digital system. And so the question is just, consumers, households have direct access to safe central bank money today, and they can use that for payments, but payments are moving digital. And so the question is, in the future, do we want households to continue to have direct access to safe central bank money?
Yeah.
The question also is, in the future, if stable coins become the predominant mechanism for a digital representation of the dollar, what kinds of instability and fragmentation that might lead to, and if stable coins are the only digital representation of the dollar, does that potentially handicap us in the international environment? Those are just the questions.
All right, I'm going to interrupt you. I'm getting Fed speaked and a little filibustered on that. So is that a yes? You do agree with that? Now I can't hear. I don't know.
I really think the right way to think about this is the future state of the payment system, not what the payment system looks like today. Again, it's just about just evolving so rapidly.
All right. Well, I look forward to the answers from Chair Powell in response to our letter. I assume you will have involvement on, and so I'll move on to an additional question. And I know this was something that's been on the mind of a number of colleagues. I'm curious why you think a well-regulated stablecoin would reduce the deposit base even more than a CBDC and even an intermediated CBDC, which would still could that still possibly erode deposit base like the digital yuan?
So I don't actually have any way of knowing whether well-regulated stablecoin, how much that might influence the deposit base relative to a digital dollar. Really, yeah. So I don't. I can't assess that.
I want to get to my final question. In February, when we had Treasury Undersecretary Lang up to testify on the Presidential Working Group on Financial Markets Stablecoin Report, I asked her about agency coordination. And like Treasury, the Federal Reserve was part of the working group. Just about a month or so before the release of the report, SEC Chairman Gensler stated in an interview that stablecoins, quote, may have attributes of investment contracts, have some attributes like banking products, but the banking authorities right now don't have the full gamut of what they need and how we work with Congress to sort through that, close quote. And since then, the SEC has continued to offer contradictory statements, providing little or no clarity on the issue. Vice Chair Brainard, we've talked a lot about this afternoon about stable coins and how a CBDC would be in direct competition to them, but clearly the SEC has a role to play in all this. Can you briefly explain to the committee how the Federal Reserve is coordinating with the SEC on that particular issue?
Yeah, just on, I actually see a potential digital dollar issued by the central bank as complementary to private sector innovation and to stable coins as coexisting with central bank, with commercial bank money and stable coins, and potentially actually spurring private sector innovation. So a little different. And of course, we collaborate closely with the SEC. Very important.
I yield back.
Thank you very much. The gentleman from Massachusetts, Mr. Auchincloss, who is also the vice chair of the full committee, is now recognized for 5 minutes.
Thank you, Madam Chair and Vice Chairwoman. I appreciate your time today and your answers in this long session. When you get to me, you're almost done. I'm also glad that over the course of this session, you have really cleared up that you agree that you require congressional authorization to issue a CBDC. You had me a little nervous there at the top of the hearing, but I'm glad because I strongly believe that both the letter and the spirit of the law is such that you would need congressional authorization to issue a CBDC. And that's important because I think there's a lot of skepticism still that I'm hearing and that I share about the utility of a CBDC, both because it's a solution in search of a problem, although you have offered a couple of potential solutions, because of the security, cybersecurity of this, because of its potential to infringe on Americans' privacy, and because anytime you have programmable currency in the hands of a centralized power, you risk the fact that it can be politicized very easily. And that would be hugely detrimental to the United States dollar being the world's reserve currency. However, I strongly support your pursuit of research and development on a CBDC because I do think it gives us better standing in negotiations for international protocols. And so I think the R&D is good, even though I'm not sold that it should go on to the product stage. I want to continue on the line of questioning from my colleague from Ohio, Mr. Gonzalez, about fragmentation. You've offered as one of the potential reasons for a CBDC that it's the only way that you've got the full faith and credit behind a stable coin. I don't really understand that because a well-audited and transparent stablecoin regime like we've seen with USDC really does de facto have the full faith and credit of the United States dollar behind it because it's got US dollar denominated securities behind it. It's really just one step removed. Am I missing something there?
Well, I think it's quite different to actually issue the digital asset as opposed to a digital asset that has reserves behind it.
Why? For purposes of actual use in the market, why is that different? If you've got a stable coin that is directly backed, audited, and disclosed by fiat currency that is the full faith and credit, what's the missing link there?
The missing link is that you would have one tokenized asset that would be seen as having the full faith and credit of the U.S. government behind it because the U.S. government actually issued it. And
yeah, but again, we're kind of going in circles here because something like USDC is backed by U.S. dollar denominated currency that is the full faith and credit. So it just, as long as there's an auditing and disclosure regime for the stable coin, you've got the full faith and credit behind it. Now, the market can price whether they think the liquidity is appropriate, whether it's 90-day securities or 180-day or
the market
et cetera.
That may be right, but clearly in the case of money market funds, that ability hasn't been foolproof. And so we've seen runs on money market funds repeatedly, actually. So it is different to have a stable coin than to have a currency issued by the central bank. And there are a number of protections that you can kind of layer on. The more you layer on those protections, of course, the more that private sector asset may be less able to be used in certain ways. So there's a trade-off there.
Reclaiming my time, then, Vice Chairwoman, you've been promoting this idea of a CBDC also as a solution to fragmentation and as even undergirding public-private coexistence here. I still was unclear with your answers to Mr. Gonzalez, though, how it would help fragmentation to add a CBDC into the mix. What is the actual technical process by which you're improving interoperability in some way?
Well, it's creating one asset that every other stablecoin can be seamlessly transferred into and out of. So
But we can do that without a CBDC.
not unless they're interoperable. Not unless they're interoperable, which requires standard setting and some kind of central agreement around interoperability.
But we could focus on the standard setting and get to the same interoperability without a CBDC.
Yeah, I think the question is just whether you want that amount of complexity in the regulatory regime.
Thank you. Thank you very much. I'd like to thank Vice Chair Brainard for her testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for Vice Chair Brainard to the chair, which will be forwarded for her response. Vice Chair Brainard, I ask that you please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. With that, this hearing is adjourned. Thank you all so very much.